Welcome back to The Deep Dive, the only show that's really engineered to deliver that comprehensive, synthesized insight directly to you, the learner.
And today we are wading into probably the most volatile, paradigm-shifting market phenomenon of the decade.
We have to be talking about the artificial intelligence revolution.
Mm-hmm.
Specifically, generative AI, large language models.
It is a phenomenal moment. I mean, it's one where technology is genuinely changing the way we all work and live.
But for investors, that tension it's almost unbearable.
It is. You have trillions of dollars valuation resting on a single, really a binary question.
Right. Is this rise, this thing being led by the so-called Magnificent Seven stocks, is it a true secular economic shift that actually justifies these prices?
Or is it simply a classic speculative mania, just, wearing a new digital disguise?
And that kind of ambiguity, it demands an analysis that looks way beyond just the quarterly earnings reports. We need a guy who specializes in investor behavior.
Someone who's survived and documented multiple cycles of excess and panic.
Exactly. We need a philosopher of the market, not just a spreadsheet jockey.
And that is precisely why we're dedicating this entire deep dive to the work and wisdom of Howard Marks,
The co-chairman and co-founder of Oaktree Capital Management.
Right. Marks is recognized not just as a successful investor, but really as an intellectual giant in finance. His expertise is in dissecting investor psychology, mapping those market cycles.
And translating these complex historical risks into something you can actually use.
Exactly. His famous memos, especially on Bubble Watch, and the more recent one, Is It a Bubble?, they're going to be the source material for today.
So our mission is to really dissect his incredibly nuanced diagnosis of where we are right now.
And he's not calling for a crash tomorrow, but he is sounding a very clear alarm.
He labels the current environment as lofty, but not nutty.
A very specific choice of words.
It is. And our goal is to take you through his entire intellectual framework, integrating historical ghosts like the TMT bubble and the Nifty 50 with all the unique structural risks of the AI ecosystem.
So that you can understand exactly what lofty but not nutty means for your portfolio today.
Okay, before we embark on this analysis, we do have to share a necessary note for you, the learner.
All the analysis we're sharing here is strictly based on publicly available sources, and it's intended for educational purposes only.
This content does not, under any circumstances, constitute investment advice. We really urge you to conduct your own due diligence before making any investment decisions.
And if you find these deeper insights compelling, we'd encourage you to join the Deep Value Club membership for more advanced, in-depth content.
You can also subscribe to us on Apple and Spotify podcasts. Just search for Deep Value Investing.
And for those interested in tracking the total market temperature that Essential Gauge Marks tells us to watch, we'd recommend searching for and downloading the iOS app, a Buffett Indicator, from the Apple App Store.
Yeah, that's a fantastic tool for monitoring current market valuations against, historical norms. A really useful piece of kit.
Definitely. Okay, thank you for that. With the context set, let's now begin our deep dive into Marx's intellectual architecture.
Right. Understanding his definition of a bubble is really the first step to understanding the AI market today.
So Marx argues that if you rely solely on, say, quantitative metrics to define a bubble, you're going to miss it every single time.
So to really appreciate his lofty but not nutty verdict, you have to accept his foundational premise.
Which is that bubbles are fundamentally psychological events. They're driven by emotion, and only secondarily do they manifest in the mathematics evaluation.
So we've got to look beyond the spreadsheets. What you're saying is that traditional metrics like a P/E ratio of 30x or 40x, they're just symptoms of a bubble.
Exactly right. They are not the cause itself.
So what's the cause?
The cause is a breakdown of human reason. Marx defines a bubble as a state where that intense emotional desire to get spectacularly rich just completely overwhelms the rational, calculated fear of loss.
The collective mind in the market it shifts.
It transitions from prudent calculation to a mass suspension of disbelief. The numbers only become impossible because the psychology became impossible first.
But that mass psychology of envy is just such a powerful force in markets, isn't it?
Oh, it's everything.
It's what breaks the discipline of even the most seasoned investor. Which reminds me, Marx frequently points back to the canonical source on this psychological breakdown.
He does. He often cites that powerful insight from economists Charles Kindleberger and Robert Alibur.
From their book, Manias, Panics, and Crashes.
Right. The central line is, there is nothing so disturbing to one's well-being and judgment as to see a friend get rich.
That is the idiot neighbor paradox in its purest form.
Yes.
You, the disciplined investor, you're sitting there on your steady, maybe 8% returns, And your neighbor, who bought some random, highly leveraged tech stock based on a social media rumor, is bragging about a 300% gain.
That envy, it just starts to eat away at your own certainty. You start questioning your proven rules.
That's the seed of irrationality.
And that seed, it blossoms very quickly into what Marx calls the no price too high syndrome.
Okay, break that down.
Well, in any efficient, healthy market, there's a natural governor, right? It's risk aversion. As an asset's price rises, its potential for future returns goes down and its risk goes up. So demand should eventually fall.
But in the middle of a speculative mania, market physics just seem to invert.
Precisely. Rising prices start to generate increased demand, and it's driven entirely by the fear of missing out FOMO.
The higher it goes, the more people want in.
Exactly. The higher the asset goes, the more validated the early buyers feel, and the more anxious the latecomers become about being left behind.
And Marx pinpoints that crucial transition point. It's when investors stop asking the necessary, disciplined question.
Is this asset worth the price based on its projected future cash flows?
And instead, they capitulate. They start asking.
I must own this at any price or I will miss the future.
And once you start hearing those verbal markers, you know you're deep in the woods. You hear fund managers and commentators dismissing basic principles.
Oh, you hear it all the time. Phrases like, valuation doesn't matter for a company this good,
Or PE ratios are an artifact of the industrial age. Those statements are the loudest alarm bells a disciplined investor can possibly hear.
They signal that the narrative is trying to provide cover for bad math. And these manias, they require a specific breeding ground.
The new thing.
The necessity of the new thing. Bubbles rarely form around, established, mature industries like electric utilities or consumer staples. They need a technological or financial innovation.
Like railroads, the transistor, the internet.
Or today, generative AI, something that promises to fundamentally change the world.
It's that seductive power of the "this time is different" argument.
Which John Templeton famously called the four most dangerous words in investing.
Right.
And that narrative, it provides the intellectual justification for suspending your valuation discipline. Marx emphasizes the crucial fallacy here.
It is.
Investors conflate the validity of the technology with the value of the equity.
Okay, that's a key distinction.
We can all agree that AI is transformative. That's the validity. But the fallacy is in the next step. The belief that because the technology is transformative, the profits must be infinite, and therefore, the equity must be worth any price.
And that's what allows the multiples to expand to levels that are just mathematically impossible to justify under any reasonable assumption.
That's the trap.
That framing is essential.
Okay.
Okay, let's unpack this with Marx's specific diagnostic tool, the 3 stages of a bull market. This gives us a structural way to figure out where we are right now.
Yeah, this heuristic is fundamental to how Oaktree approaches cyclical positioning. It defines the psychological shift in 3 clear stages. Stage 1 is the recovery phase.
This is right after a deep recession or crash.
Exactly. Only a few unusually insightful people are buying assets. They're recognizing deep value when everyone else is just paralyzed by fear.
This is the period of maximum discomfort and maximum potential returns.
That's where you make the easiest money, but it feels the hardest to do. Then comes stage 2.
The realization phase.
Right. The economy improves, earnings growth accelerates, and most people accept that improvement is actually taking place. This is the healthy, rational bull market.
So prices are rising because fundamentals are genuinely getting better.
Correct. Earnings are increasing, and the risk-reward trade-off still remains reasonable.
And stage 3. That's the danger zone. The transition from stage 2 to stage 3 is the single most critical judgment an investor has to make, isn't it?
It is. Stage 3 is pure, unadulterated euphoria. After years of strong gains, investors just lose all perspective. The consensus concludes that things can only get better forever.
Risk aversion evaporates.
Speculation becomes the norm, and skepticism is actively ridiculed.
So Marx's current challenge, and really the focus of his latest memos, is pinpointing if the AI boom is still a justifiable stage 2 growth rally supported by exploding earnings, or if the psychology has already crossed into stage 3 mania.
And he's got a diagnostic marker table to help with that.
Let's use that to summarize the difference between those 2 psychological states. This helps synthesize the behavioral cues you need to be watching for.
The contrast is pretty stark. In a healthy bull market, stage 2, investor sentiment is optimistic, but it's grounded in economic data.
But in a speculative bubble, stage 3, it's outright euphoric. It's driven by pure consensus and that overwhelming belief that, yes, this time is different.
And the practical difference in how assets are valued is maybe the most glaring sign. In stage 2, valuation methodology is focused on tangible reality. Earnings, cash flow, replacement cost.
But in stage 3.
It shifts entirely to abstraction. It becomes what Marx calls price to dream, or new nonsensical metrics like user growth or eyeballs.
We remember eyeballs.
Right. People are no longer grounding their valuations in discounted future cash flows. They're pricing based on the maximum possible future scenario.
And we also see that fundamental shift in risk attitude. Stage 2 is fundamentally loss averse. You're asking, how much can I lose if this doesn't work out?
But stage 3 is entirely dominated by FOMO. It's only asking, how much can I make if I'm right? That shift from mitigating loss to maximizing gain is a hallmark of euphoria.
And market breadth is critical too. Healthy stage 2 markets, they see broad participation across sectors. A rising tide lifts all boats.
But bubbles are defined by extreme, narrow concentration in the new thing, a phenomenon we are certainly witnessing today with the Magnificent Seven.
And finally, that treatment of skepticism. In a healthy market, if you voice doubt, you get a constructive debate.
But in a stage 3 environment, if you voice doubt, you're just dismissed as a dinosaur who's incapable of grasping the future.
That's a huge tell. If you start to feel intellectually attacked for simply asking about valuation, you're very likely in stage 3 territory. Okay, that framework gives us the surgical tools for analysis. Now, Marx insists that to understand the risk of AI today, we have to look backward. The market has been here before, many times.
So let's start with the precedent that really solidified his reputation as a cycle expert, the TMT bubble.
Technology, media, telecom, 1999-2000.
Marx's memo, bubble.com, was just a masterpiece of timing and insight. It came out in January 2000, just weeks before the NASDAQ Q peak.
And it was a direct, rational, intellectual assault on the prevailing mania.
The specifics of that madness, they were astonishing, even looking back. You had companies with zero profits, often minimal revenue, commanding billion-dollar market caps based on metrics that were pure fantasy.
He identified the fundamental economic error of that era.
The volume over margin fallacy.
We joke about it now, but people really believed it.
The actual stated operating belief for many dot-coms was that they were losing money on every single transaction, but somehow they'd scale up, achieve massive volume, and then magically become profitable later. It just defies basic economics.
And here's the key lesson for AI. Marx made that crucial distinction that the internet did change the world. The validity of the technology was absolute.
But that validity was not enough to save investors.
Right. The enduring lesson is the validity valuation gap.
Marx frequently reflects that the underlying premise that the internet would transform society and commerce came absolutely true. Yet the vast majority of those .com and e-commerce stocks that benefited from that thinking...
They're worthless now.
Yeah.
Or just gone entirely.
Exactly. Being right about the profound impact of the technology is necessary, but it is not sufficient for making money. Valuation is the ultimate arbiter.
So let's apply that gap directly to today's AI infrastructure. Today, NVIDIA and other chip makers are universally hailed as the essential pick-and-shovel suppliers of the AI gold rush.
Right. So who are their closest equivalents during the .com era?
The infrastructure builders.
We're talking about companies like Cisco Systems, Lucent Technologies, JDS Uniphase. They weren't pets.com.
No, they were building the physical backbone. The routers, the switches, the fiber optic lines that enabled the internet to function at scale.
They had real products, exploding sales, and they were profoundly profitable at the time. They were superior established businesses.
And yet, even Cisco, a fundamentally great company that was essential to the technology's long-term success, suffered an absolutely catastrophic fate.
It just shows how dangerous the entry price is.
The losses were breathtaking.
Cisco lost nearly 90% of its market value from its peak in March 2000. And what should haunt today's investors is the time horizon.
How long did it take to recover?
It took Cisco, arguably one of the most successful technology companies of the past 30 years, roughly 20 years, to simply regain its March 2000 high.
2 decades of zero return for buying a great asset at a catastrophically high price.
And this illustrates the primary risk for AI today. You can be perfectly right about the technology that AI will dominate, but if your entry price discounts a future that is too distant, too optimistic, and ignores competition...
your investment outcome can still be devastating.
Exactly.
That analogy suggests the AI risk isn't just about the outright speculative garbage, but about buying high-quality, essential assets at an unsustainable multiple.
Right.
But the TMT comparison focuses on companies with no earnings. Marx often references another historical parallel that feels closer to the current valuation structure of the Magnificent Seven,
The Nifty 50.
the Nifty 50 from the late 60s and early 70s. These were the original one-decision stocks.
Right, companies perceived as being so high quality, so reliable, so dominant that the decision was simply to buy them and never sell, regardless of the price.
We're talking about the titans of that era: Xerox, Polaroid, Coca-Cola, Disney.
Procter & Gamble, IBM, McDonald's, these were not small-cap speculative startups. They were the blue-chip growth stocks of their day.
Right.
But because of this universal, unquestioning consensus on their quality, they traded at PE ratios that are shocking by historical standards.
How high are we talking?
Often hitting 70x, 80x, even 90x earnings.
Wow.
The prevailing theory was that quality was worth any price and they were too high quality to fail. Then the deep recession and bear market hit between 73 and 74.
And the simultaneous collapse of multiples and earnings meant their valuations were just crushed.
They were. But the critical warning for the Magnificent Seven isn't just the price collapse, it's the lack of persistence of that dominance, isn't it?
That is the most salient point for today. The current assumption embedded in the market cap of the Magnificent Seven, Google, Microsoft, NVIDIA, Apple, etc., is that they will remain globally dominant and compound earnings at 20% to 30% annually, forever.
And the Nifty 50 history just violently counters that.
Where are Polaroid, Kodak, and Xerox today?
They were disrupted. They didn't persist. Technology and dominance are transient. The assumption of infinite compounding is a bet against the very nature of aggressive capitalism and technological change, which, it thrives on disruption.
So whether we look at the pure speculation of TMT or the excessive quality pricing of the Nifty 50, the lesson is clear. Being right about the future doesn't make up for bad valuation discipline.
Right.
Let's shift gears now and apply these historical lessons to the specific structure of the AI landscape today.
Marx readily concedes that AI is the definitive new thing of this cycle. I mean, its capacity for rapid learning, generating sophisticated code, passing the Turing test, feels genuinely unprecedented.
Almost like magic. And that sense of magic is what allows the investor to throw out the rule book. If it's magic, how can you possibly value it?
That's the intellectual trap. And Marx identifies 3 specific elements that make AI a particularly fertile ground for speculative excess, maybe even more so than the internet bubble.
Okay, what are they?
First is the promise of omnipotence. The narrative surrounding AI suggests it's going to solve everything from climate change to curing disease, creating an infinite, total addressable market mindset.
And if the market is infinite, then any current price can be justified.
That's the thinking. The second is the complexity, the black box nature of the underlying technology.
Right, the lack of understanding.
This is a major differentiator from the internet. Few investors, even the most sophisticated professionals, can independently verify the fundamental claims made by management teams about their proprietary models or capability leaps.
So this complexity forces you to rely on hype, on the narrative and the credibility of the speaker, rather than hard, independently verifiable fundamentals.
You're buying on faith, which is the definition of stage 3 psychology.
And the third element is that sheer corporate terror that's driving immediate spending.
The fear of obsolescence. This is an existential threat driving institutional capital. Every CEO, every board member is terrified that if they don't invest in AI infrastructure immediately, their company will become irrelevant within 5 years.
So this drives what Marx calls forced buying capital deployment, regardless of price or proven utility.
Right. And this pressure is internal and almost impossible to resist, which just artificially inflates demand.
Okay, this analysis leads us to a crucial and very sophisticated point that Marx and Oaktree have raised regarding the structural risks of the current revenue model.
The risk of the circular economy. This is a deep analytical cut that needs far more exploration.
Yeah, let's break it down.
We are currently deep in what the economist Carlota Perez calls the installation phase, the colossal build-out of physical and digital infrastructure.
And the obvious beneficiaries are the chip makers, followed by the cloud hyperscalers.
Right. And the market is pricing these two groups for perpetual exponential growth.
Marx draws an uneasy historical parallel here to the late 1990s telecom bubble, which was riddled with capacity swaps.
Let's walk through that parallel.
Yeah.
In the 90s, telecom companies sold fiber optic capacity to each other to book revenue and meet Wall Street growth expectations.
So the demand was internal to the industry. It wasn't based on proven end-user subscription growth.
Exactly. It created an illusion of robust demand and profitability that just vanished when the internal trade dried up. And Marx suggests we may be seeing a modern AI version of this financial loop.
Let's follow the money trail in the AI circular economy, because this is where the risk crystallizes for the learner.
Okay, it starts with the AI chip makers who are reporting massive revenue growth, trillions in value added in just 2 years.
That revenue is largely funded by the vast capital expenditures, the capex of the cloud hyperscalers.
Amazon Web Services, Microsoft Azure, Google Cloud, they're essentially buying the new digital oil rigs.
Right, the hyperscalers are spending hundreds of billions on hardware. Now, where does their money come from?
Well, they attempt to recoup that spending by selling computational time and services to the third layer. The thousands of AI startups, smaller enterprises, and corporate development teams.
And crucially, the hyperscalers often fund this layer of demand by giving out huge amounts of cloud credits.
Or by taking equity stakes in the startups that are then forced to spend their operating capital on their cloud platform.
So the startups spend their cash or credits on the cloud services of the hyperscalers, who in turn use that massive revenue to justify buying the next generation of expensive chips.
It's a closed loop.
A self-referential circle of cash flow.
And Mark's central question, the one every investor has to ask, is where is the actual proven external user paying cash for productivity gain that justifies this entire massive cycle?
We're still waiting for the deployment phase.
We need actual businesses paying cash to AI services that genuinely improve margins or productivity outside of this tech and startup bubble.
So the potential reversal, the Wile E. Coyote moment you mentioned earlier, comes if those hyperscalers can't monetize their data center capacity fast enough.
Or if the startups run out of runway. If that external real-world monetization doesn't materialize soon, the hyperscalers will see their enormous capex as stranded assets.
And they will immediately slash their orders for chips.
Leading to a sudden, dramatic contraction across the entire valuation pyramid, starting with the chip makers. Marx explicitly warns that the fierce competition among the leading tech firms means they may be content to experience losses in their AI businesses for years in order to gain share.
Which suggests a margin-destroying battle is ahead, and that's not currently factored into the stock prices.
Not at all.
Yeah.
And this structural fragility is made exponentially worse by the sheer concentration of the market.
The Magnificent Seven concentration risk.
The degree of market concentration is historically extreme. A handful of names now account for the overwhelming majority of the S&P 500's performance over the last 2 years.
And while these are fundamentally superior businesses to the dot-com era, they have massive cash flows and established moats, the concentration itself creates systemic fragility.
Meaning that if the AI trade unwinds, passive investors are inherently making a massive, unacknowledged active bet that will hit the entire market.
Exactly. Anyone invested in a broad index fund like the S&P 500 is now implicitly making a huge leveraged bet on the perpetual dominance and valuation of these 7 companies.
And Marx cautions that we must not forget the law of large numbers. It's encapsulated in his famous maxim, trees don't grow to the sky.
Right. The underlying assumption that these companies will continue to compound earnings at 20–30% indefinitely is mathematically highly skeptical.
And it's fundamentally a bet against competition, economic gravity, and the entire history of corporate dominance.
So we've built the necessary intellectual structure, we've reviewed history, and we've assessed the current structural risks, especially the fragility of that circular economy.
And this brings us back to Marx's central conclusion. Lofty but not nutty.
This is a profoundly important distinction. Why is he so unwilling to use the word bubble today?
The distinction lies entirely in separating an expensive market from an irrational, manic one.
Okay.
If the market is merely expensive, say it's trading at 25x or 30x PE, the risk profile is stagnation, poor future returns, or maybe a cyclical correction of 20–30%.
But if it were a full-blown nutty bubble where PE is infinite or just irrelevant, like in 2000?
Then the risk is a catastrophic 50% to 80% market crash.
The firewall preventing the nutty status, then, is real profitability.
It is. Marx classifies the AI market as lofty because the key drivers, the chip makers and the hyperscalers, have massive, undeniable profitability. NVIDIA, Microsoft, Google, these are not pets.com.
No, they have huge existing businesses, vast cash reserves.
And crucially, their earnings growth has, for the most part, been phenomenal enough to keep pace with the price appreciation, although just barely.
So the multiples are elevated and stretched, making them lofty, but they're not based on non-existent profits.
Which was the definition of nutty in 2000.
This suggests the air in the balloon is just very thin, not entirely absent. But how does Marx gauge the psychological temperature? We established that bubbles are defined by psychology, so what's the final indicator of mania?
He relies on his most reliable real-world indicator, the man in the street indicator.
Right.
Marx believes unsustainable manias only happen when speculation permeates the entire society. It has to move beyond professional investors and dedicated tech enthusiasts.
In 1999, it was the taxi drivers, the bartenders, the hairdressers giving you stock tips.
Telling you to quit your job to day trade. And his current observation, he states clearly, I don't detect that level of mania at this time.
So the euphoria is largely contained.
It's contained within the professional investment community, the Silicon Valley ecosystem, and those already actively trading. The average household isn't yet pulling out their home equity to invest in AI microcaps.
And the absence of that society-wide universal mania is the key psychological factor preventing him from upgrading the verdict from lofty to nutty.
That's the firewall.
But if the man in the street indicator is the only thing preventing nutty status, doesn't that make the current situation incredibly fragile?
It's absolutely fragile, and Marx acknowledges that psychological stability can break very quickly.
So he's really relying on the absence of evidence, the absence of universal euphoria, rather than positive evidence of valuation support. That seems inherently risky.
It is, which is why he categorizes the current environment as late stage 2 or early stage 3. The difference is critical for positioning. Let's look at his comparative analysis of the 3 major bubbles he's documented.
Okay.
The TMT bubble of 2000 was nutty. It was characterized by non-existent profitability, speculative business models, low corporate debt.
The housing bubble of 2008 was toxic.
Driven by extreme systemic credit risk and bank leverage. The underlying assets were priced reasonably, but the debt structure was fatally flawed.
And the AI boom of 2024 is lofty.
Characterized by high PE ratios applied to real massive earnings and, crucially, high corporate cash reserves rather than extreme systemic debt leverage.
That context shows the risk isn't toxic credit, but simply stretched pricing. But this entire lofty market is now colliding with a massive macroeconomic sea change.
This is perhaps the most important context for long-term investors.
The gravity of rates.
Yes. Marx argues that the 40-year era of secularly falling interest rates from 1980 to 2021 is fundamentally over. We've entered a new epoch defined by persistent structural inflation and a real persistent cost of capital.
The end of free money, essentially. We need to explain clearly to the learner why near-zero interest rates were the lifeblood of high-growth tech valuations.
It all comes down to the mechanics of discounted cash flow.
How you value any asset that promises future profits today.
Right. When interest rates are 0 or near 0, the discount rate, the required rate of return you use to calculate present value, is negligible. If money is free, the value of those massive theoretical AI profits promised 10 years from now is exponentially higher.
Potentially infinite.
It creates the perfect gravity-free environment for long-duration growth assets like tech stocks to soar.
But now we live in a world where the Federal Reserve is holding rates at 5% or higher, and the risk-free return on cash is 4% to 5%.
That changes the gravity entirely. When the discount rate moves from 1% to 5%, the present value of those far-off future profits just collapses dramatically.
Give us an example.
Okay, a $1 billion profit projected 10 years in the future. Discounted back at 1%, that profit is worth about $905 million today.
Okay.
Discounted back at 5%, the same $1 billion profit is only worth about $614 million today.
That's a 32% valuation haircut just from the change in the interest rate environment.
It illustrates the point perfectly. Higher interest rates structurally raise the hurdle rate for equities,
making current profits more valuable than future profits.
Absolutely. Marx warns that investors who are today applying the 2021 multiples, the zero-rate valuation standards, to 2024 interest rates are engaged in a massive structural mismatch bet. Higher rates naturally pull down valuations. Even if AI succeeds, the increased cost of capital will test the validity of every high multiple in the current market.
So we have a market that is lofty, high risk, high prices, but not completely divorced from reality. And that market is colliding with the gravity of high interest rates.
Right.
Marx famously avoids market timing, but he does advise investors on how to define where we are in the cycle.
Yeah.
So what is the prescriptive advice for the learner?
His core message is that knowing where we are, late stage 2, early stage 3, where comfort is high and skepticism is low, dictates a necessary defensive shift in your risk posture.
So he advises moving to what he calls an investment readiness condition.
It's characterized by increasing defensiveness, trimming back risk exposure, and optimizing your portfolio to survive the inevitable collision between infinite expectations and economic reality.
The goal is survival and preservation, not speculation.
Exactly.
What does that defensive posture look like in practice? Let's detail the defense tactics.
First and foremost is the discipline of trimming winners. Marx argues that if you've been heavily invested in the AI trade and have seen violent appreciation, you have to take some chips off the table.
This isn't about selling everything.
No, it's about rebalancing your portfolio. When a single asset's appreciation dictates your entire risk exposure, you are speculating, not investing. Trimming removes that exposure and frees up capital.
You're rotating away from the assets where the consensus is highest and the comfort is strongest.
Exactly. Secondly, emphasizing value. You need to rotate the capital you just freed up into neglected sectors or assets that have demonstrable current cash flows and reasonable grounded valuations.
So these are often found in the old economy sectors, like traditional energy, utilities, specific industrials.
Things that haven't been subject to the same speculative fever. You're moving from a price-to-dream model to a price-to-cash flow model.
And the most important attitude shift is the commitment to skepticism.
You have to apply a much higher burden of proof to every new investment idea, especially those linked to the AI narrative. Stop asking the stage 3 question, how much can I make?
And force yourself to focus on the disciplined stage 2 question.
What could go wrong? What is the downside scenario? The current market narrative is universally positive. The professional, second-level investor must adopt a universally skeptical position.
Now, as the co-chairman of Oaktree, Marx is fundamentally a credit and distressed debt investor. He highlights a crucial structural advantage of debt in a lofty market like this.
Yes.
Why does credit become relatively more attractive when equity is priced for perfection?
The difference lies in the payoff structure. In equity investing, you need the price to rise, you need the company to outperform expectations. It's a highly variable and unpredictable outcome.
But in credit investing, in debt, your outcome is fixed.
You just need the company not to go bust to receive your fixed contractual return principal plus interest. When equity is priced for absolute perfection, that variable outcome is highly dangerous.
So instead of betting on which AI giant will win the long-term competition, you might just lend money to the essential infrastructure that supports all of them.
That's the strategic pivot. In a winner-take-all environment where equity prices are disconnected from reality, lending to AI-adjacent infrastructure data center operators, power generation facilities, networking providers, it offers high yields with debt-like protections.
You get paid well as long as the underlying company survives.
Regardless of whether OpenAI, Google, or some startup eventually dominates the AI model space.
This all ties back to the fundamental intellectual discipline that Marx preaches, the discipline of second-level thinking.
This is the intellectual insurance policy against being swept up in the crowd.
It's the difference between making comfortable decisions and making profitable ones.
First-level thinking is simplistic, consensus-driven, and comfortable. For example, the first-level thinker observes, AI is going to be huge. NVIDIA makes the best chips. I should buy NVIDIA.
And everyone thinks that, and that consensus is already priced into the stock.
So that comfort guarantees inferior risk-adjusted returns going forward.
Right.
Second-level thinking is complex, non-consensus, and it requires genuine discomfort. It necessitates questioning the obvious trade.
So the second-level thinker acknowledges the premise. Everyone knows AI is going to be huge, and NVIDIA is priced to own the entire market forever, with no execution risk.
But then the second-level thinker asks, what if competition from AMD's new chips accelerates? What if Google, Microsoft, and Amazon successfully build and deploy their own custom AI chips, eroding NVIDIA's 90% market share and crushing their margins?
The consensus is too optimistic. The price is too high.
So I will wait for a deep pullback. Or I'll look for secondary beneficiaries like specific copper mining stocks or power grid providers that the consensus is completely ignoring.
That counterargument is the true discipline. Marx warns that any investment that feels comfortable and is the consensus trade is highly unlikely to yield superior risk-adjusted returns going forward.
The best investments are inherently uncomfortable because they are non-consensus. #outro. So to summarize our deep dive into Howard Marx's analysis, the signal regarding the current AI boom is a flashing yellow.
The technology of AI is genuinely revolutionary, but the prices associated with the leaders are elevated, stretched, and lofty.
And the combination of extreme concentration, the risk of a circular economy and revenue, and the structural gravity of higher interest rates means the risk-reward profile is now asymmetric to the downside.
The easy money in this cycle has undoubtedly been made.
It has.
The knowledge we've gained today, understanding the psychological traps, analyzing that historical Cisco analog, and recognizing the structural collision between infinite expectations and hard economic reality, this allows you to construct a portfolio that is both defensive and ready for the inevitable correction.
And Marx's ultimate philosophical warning, the one that should guide every decision, remains timeless.
What's that?
The most dangerous thing in the world is to watch your neighbor get rich.
It always comes back to that.
The investor who can resist that universal envy and stick firmly to their valuation discipline, who remembers that trees don't grow to the sky, will be the one who survives and thrives when the inevitable bust follows the boom.
That is profound wisdom worth internalizing. And as a final provocative thought for you, the learner, if the current market is lofty but not nutty, and the one thing keeping it from becoming nutty is the absence of the man-in-the-street mania, what single concrete sign, a particular type of mass media article, a specific social media trend, or a new consumer product will you look for over the next 6 months that tells you the general public has finally capitulated to FOMO?
That's a great question.
That signal will tell you the psychological peak is truly here, and it will be the time to ensure your portfolio is battened down.
An excellent point to ponder. And if you want to access more advanced, in-depth content about these topics, welcome to join the Deep Value Club membership or subscribe to us on the Apple and Spotify podcasts channel, Deep Value Investing.
And remember, to track that essential total market temperature, that objective measure of valuation marks relies on welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
Thanks for joining the deep dive. We'll see you next time.